This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The government is closed, but artificial intelligence and its economy is open, and with a lack of other focus, we'll jump in on that debate this week. Can investors see a return on the trillions of dollars being thrown at what AI will deliver? Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and it has been a kind of dull period. Not a lot of market news, not a lot of data available because the U.S. government is shut down. But Wednesday, we also ended an 8-day holiday that they have over in China and Korea, with their markets remaining closed for that whole period. So not a lot of news flow there. And I guess that's left little to talk about other than the big market mover this year, AI. And the focus appears to be, whether or not AI is a bubble. That's the topic du jour, and I'm going to share in it. There's been plenty said about this recently, and with good reason, but maybe also because of a lack of other topics. But in a featured story in the Financial Times this week, they said, quote, surging valuations of artificial intelligence companies are intensifying the risk of a sudden correction in global financial markets after equity prices reached levels comparable with the dot-com bubble, the Bank of England has warned, end quote. Now, the article went on to point out that the overall valuation of the S&P 500, the valuation to forward earnings at least, estimates now it's at 25 times that forward estimate. It's actually below that of the height of the dot-com years. And we know that half of the index itself is leveraged to exposure to the big tech companies, the hyperscalers. But they also pointed out that a repricing, if it should happen, of the AI economy could really take a toll on investors because of the kind of concentration of tech companies in portfolios, pointing out also, as I just alluded to, that almost 30% now of the S&P 500 is in 5 companies, the top 5 big tech names. However, the Financial Times also went on to say, as I pointed out on the podcast 2 weeks ago, that credit spreads, it's the premiums investors get paid for taking on additional risk in debt at lower credit qualities, well, that's at a historic low, meaning that capital is chasing yield, capital is chasing a home, and investors are just not being rewarded right now adequately for the additional risk. That suggests, as I'm hearing more often lately, that there's kind of more risk in the bond market than in the stock market. And that may be true for bond traders, maybe for kind of more sophisticated investors today. There's a lot of capital out there, big-time investing, that chases opportunities in bonds as they do in other assets for what I'll say is a traded return. They're leveraging one asset versus another, and also includes those trades factoring in an expected return based upon changes in currency valuations, which also includes the effect of different central banks' policies versus one another. However, I'm assuming for most of the people who listen to this, for a more typical investor, what you may care about is a passive return on bonds, where yields are taken and bonds are typically held to maturity. And in this environment, if yields do indeed continue to trend lower, investment-grade bonds offer the opportunity to lock in some yield rather than seeing the risk of that yield or that value eroded as that yield on, say, cash holdings head lower, and perhaps the dollar also continues to weaken, which basically equates to a very basic definition of inflation. Now, these historically low spreads are risk premiums, would suggest you should be careful with chasing after more yield if you were inclined to chase into lower credit quality offerings. And there's a big story out there now about a very big privately held auto parts manufacturer that turned sour very quickly and basically ran into bankruptcy within a short period of time. Well, I guess bankruptcy ultimately always happens on any given moment, but this kind of spiraled out of control very quickly over the last month and left their creditors in a bit of a pickle. But for ordinary investors, buying and holding a portfolio of investment-grade bonds still offers a chance to bring stability and bring some yield, and yields that are expected to exceed inflation, which could add some preservation to your capital. Your mileage may vary, but when it's being said there are greater risks in the bond market, they're not necessarily talking about the risks of default hitting the type of portfolio I'm describing there, or at least not in relation to the risks relative to a stock portfolio. Now, how this is being played out in the global markets is a heck of a run-up in the price of gold, as a weak year in the dollar that JP Morgan expects to continue into next year, and increasing talk of debasement. More stories about other nations having gotten out of their debt through inflation, basically printing money, and stories on how that may be ultimately a path that we're heading towards. Now, that is very far from a foregone conclusion, but it is a looming or burgeoning risk. Now, according to a piece in the Wall Street Journal this week, quote, if investors expect debasement, it is very odd that the bond market's best guess at long-term run inflation, the so-called break-even inflation rate for 5 years, starting in 5 years' time, is basically unchanged and close to the Fed's 2% target, end quote. Now, for now, it does appear that this talk and its effect on the market is largely limited to these investment schemes that are leveraged to the relativity trades, playing one nation's debt versus another, using combating monetary policies, relative debt to GDP, the currency effects. But it's worth knowing about. I'd say worth watching. This isn't a week-to-week, certainly not a quarterly story, but it's a long-term story that you should be read in on because it has ramifications as policies and economies evolve, especially if we start to consider the real impact on the overall economy of this AI revolution. But I'll circle back to that later on. As I mentioned a couple of weeks ago on the podcast, there was an interview that David Tepper gave on CNBC, and I do think he's one of the names generally worth watching or listening to. And an article about that interview pointed out that a year ago, he came out and declared that he was going to bet big on China, when typical investor, the markets were otherwise seemingly treating that as a kind of a toxic area for Western investors. And China's stocks have had a pretty strong rebound this year, to which Tepper commented in this recent interview that his bet has, quote, turned out to be half decently good, end quote. But the point of the interview was that he said that the markets do here, the U.S. markets, do appear rather expensive to him right now, but, quote, you've got to stay for some of this party because the punch bowl is still there, end quote. And that it's continuing now with the help of the Fed, and that, quote, I don't love the multiples. This is David again saying, I don't love the multiples, but how do I not own it, end quote. Now, Goldman Sachs put out this week a global strategy paper, and they titled it, quote, Why We Are Not in a Bubble Yet, in which they started off by saying, their opening salvo in the piece was, quote, history suggests that bubbles are often driven by exuberance that builds around a transformative technology, attracting investors, capital, and new entrants. Bubbles exhibit rapidly rising asset prices, extreme valuations, and significant systemic risks driven by increased leverage, end quote. Well, to me, that all sounds similar to what we're seeing today. And after my break in a bit, I'm going to get back into some thoughts on AI's chances of actually ever making any money. But what is largely absent from that formula today, what was present in 1999 and largely the cause of the real debacle in 2008, is the leverage part, which isn't there to that sort of same degree there is today. I mean, there's a heck of a lot of capital being thrown at these trends, but not with the same kind of margin level risk that we saw in the markets in the late 90s, or the systematic leverage that kind of riddled our economy in 2008. So there is a lot of capital being put at risk, but not with the debt leverage on top of it, which adds a heck of a lot of contagion risk. Not saying it's not there, because it is unbelievable amount of capital being invested in AI, but doesn't at least have that leverage. Right now, Wall Street is pricing in and I guess justifying these market valuations by estimating a consensus, according to FactSet. Wall Street is estimating earnings growth for next year of 13.8% on revenue growth of 6.6%. And a lot of that is from the huge returns, not on what AI is going to deliver, but the spending on it still. The earnings that's coming from all this capital being invested. And Goldman acknowledges this absence of leverage to a degree, but they go on to point out that the appreciation is driven by fundamental growth, they say, which is where that earnings growth next year is going to come from, not so much from irrational speculation about future growth. And I'm not so sure that I agree wholly with that, because if you do look at what the valuations on the really high flyers seem to be based upon, they seem to be pricing in, when there may be no earnings now, they're pricing in expected earnings for 5 years from now, 10 years from now. For the power producers, in some cases, many, many years out before seeing any revenue. But Goldman also points out that the leading companies that are driving this, that have been seeing some of the strongest returns here, they also have, quote, unusually strong balance sheets, end quote. And that's pretty true of the mega tech names, who are issuing some bonds to pay for some of this, but they also have enormous capital on the balance sheets. And the debt, even though the debt numbers are large, it's modest relative to their overall market cap and balance sheets. But since a growing part of the debate is if these massive investments in technology will ever see a meaningful return, Goldman then did include in their title, of course, that it's not a bubble, but don't forget the yet part of this. I'm going to take a quick break here, but when I return, I'm going to dive a bit further into how much power this is requiring, what that yet means, where we're going from here, and will this all be capital wasted? For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
The new administration is certainly upturning the status quo, but you don't have to be a disruptor in your own portfolio. It could be wise to keep calm and carry on. Tune in every week as we discuss the latest financial trends and how to filter out the noise distracting you from sound portfolio management. Listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. I mentioned earlier how a lot of the narrative recently has been about valuations and maybe even using that bubble word a lot. Bubble may be forming, especially, of course, in the AI-related tech trades. Now, whether or not these valuations are sustainable and if the capital being invested into the infrastructure can ever see a return on investment, that's what's going to dominate maybe the fourth quarter this year. But where there may also be a lot of hot air within that is certainly in some of the power generating companies, some of which we like and some of which I think are resembling more meme stocks at best. Now, and I'm not going to name names, but specifically those that don't actually expect to generate any power or revenue for that matter for at least 5 or 10 years or more, if ever. So these are companies with enormous market capitalizations, stocks that have done incredibly well based upon future power generation when they're doing nothing right now. Now, while it's clear if we stay on this AI economic path not just as a nation, but as a world economy, I guess, we're going to need a ton of more electricity, of more power generated. Right here near our office, next door in Loudoun County, Virginia now has more than half of their total power consumption is going to data centers, with a whole wave of new ones being built. And per an article this past week in Bloomberg, quote, by 2030, and I can't believe that's around the corner. To me, 2030 seems like something from a science fiction novel, but 5 years from now, by 2030, AI companies will need $2 trillion in combined annual revenue to fund the computing power needed to meet the projected demand, according to a Bain & Capital piece. Yet their revenue is likely to fall $800 billion short of that mark, Bain predicted, end quote. So it's an article quoting Bain. Anyway, there are stories of these hyperscalers that are contracting their own power, right? They're kind of building their own utilities, or at least building their own stations within that utility, including some that are contracting their own sources of nuclear energy. And in some cases, at least in one case, a nuclear power startup is touting contracts for future power as part of the reason for this huge, absolutely huge run-up in the stock price. However, while that power demand is likely to be real, their actual ability to generate it anytime soon may actually be more challenging, since this company's reactor designs are many years away from getting past the regulatory process. And while some of the nuclear solutions being offered have real appeal in their theories, the applications may never overcome these obstacles to both deployment, access to fuel for them, challenges to where they're going to put these nuclear power stations, as well as ultimately showing a reasonable economic return on the investment versus other power options that are out there, even if they do offer potentially cleaner, more attractive results from other angles. But more broadly speaking about the AI economy, back in that Bloomberg article, they quoted David Einhorn, and David Einhorn, frankly, tends to be a bit of a skeptic. He makes his career as successful at times as a contrarian investor. He's a notable bear at times, but he said, quote, the numbers that are being thrown around are so extreme that it's really, really hard to understand them. And there's a reasonable chance that a tremendous amount of capital destruction is going to come through this cycle, end quote. Now, when it comes to the investment and also concerns about power generation, we also have to be concerned, as a real threat to where this path is going, about foreign competition, where overseas they might have more access, or at least be more willing to build out this grid supply that's needed for this power, and or overall be able to be more competitive on price with their AI products, that is, albeit for a substandard product. Now, per an article on the subject this week in the Wall Street Journal, we're seeing growing competition from China, where companies are flooding the market with competitive, low-cost AI models. And the U.S. is still considered to be the leader and ahead of the game as far as what we're building and building the superior models. But that might not matter when it ultimately comes down to an actual economic benefit from applying those models. So China could step in, and we had that shock briefly earlier this year by releasing their versions of this. And we could say, well, ours works so much better, so much more efficient, more intelligent. But if ours can never achieve a return on it, how's a company going to continue to invest in it if they're truly at a loss versus something that's being good enough at a much, much cheaper price from China? Now, China may be chasing our versions. They certainly may be stealing from them. But if that results in versions that use cheaper chips, use less power, and just generally cost less, well, then we may ultimately lose this race, and potentially, therefore, the return on all this capital, which is what David Einhorn is talking about capital destruction. Now, even if we have the best version, but it's too expensive to utilize or at least deliver enough earnings to the investor, ultimately, And I'm not a skeptic on AI. Not only do we've talked about companies and we have investments in it, but we need to be wary of it, not just fall in love with this idea. Because ultimately, as a whole, to make money on all this investment, it's going to have to come from a combination of economic expansion that it creates, that its presence creates an expanded value in the economy, plus the amount of savings it may create from the existing economy. And by that, I basically mean the savings that it may bring by replacing labor. Now, it can create more value or save a firm money by using its application instead of paying someone to complete that task. But that part of it, that certainly sounds destructive, and that's a whole nother conversation if it does ultimately put a lot of people out of work. Ideally, it would be taking the place of the need for additional labor that might otherwise be unavailable in the workforce. And, we're seeing small example of that right now in the economy because jobs growth is stagnating, but also we're seeing a reduction in the workforce, which is keeping unemployment, I'll say at least palatable for the moment, even though the Fed is seeing some concern there and cutting rates because of it. But we are seeing also total available workforce being depleted. However, beyond the expansion of the economy that AI could create, for a firm, it may also ultimately forego the need to import labor or outsource the job outside of this country, which economically is very similar, but it still has the net effect ultimately there of destroying a job or many jobs somewhere for someone. Now, there may be a moral debate in there, but certainly an economic one, as higher profits from the firm may not be a net gain for the economy if it's also at the cost of salary for a potential consumer. But there is room for this in this world. And by that I mean, if we look at what we're doing as a whole right now, in 2024, the United States earned about $12 trillion in total wages, according to the Bureau of Labor Statistics. So we're talking about trillions of dollars here. Total wages were $12 trillion. So there's this consideration of what damage this could have if the effect of AI, especially once it achieves AGI. That's a whole nother discussion. But go ahead and look up what AGI is if you're not familiar with it. But there's a big chunk of salary and growth to that salary number that can be eaten into, and it's ultimately how much of that $12 trillion, plus, of course, the impact on that globally, can it bite into, plus the growth it could create in addition on the global economy. That all has to add up to a return on these huge investments that are being made today. The total build-out right now is on track to be far in excess of $1 trillion. Perhaps a few of those suckers, as Alan Simpson would have said and used to say. And it's impossible to put a number on it, or at least for me, but there does appear to be a chance to see, this is definitely cocktail napkin math, but a 10-ish% return on that capital, depending on how this plays out, plus the labor creation that's in the economy from these investments. So while I do like what Goldman has to say, that it's not a bubble yet, with such a huge run, I think we are likely vulnerable at least to volatility in the near term. But the investment part of it, the capital going into it, doesn't appear to be challenged for now. So this build-out in that part of the economy will continue. It's just really important that you recognize that there ultimately has to be a return on all of this investment, or otherwise it's not just wasteful, it's actually destructive. All right, that's it for me this week. For the Wise Investor Show, I'm Chase Hinderstein. As always, thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.